Hello everybody. This time we are talking about financial modeling. Financial modeling is the process of creating a summary of a company's expenses and earnings in the form of a spreadsheet that can be used to calculate the impact of a future event or decision. A financial model has many uses for company executives. Financial analysts most often use it to analyze and anticipate how a company's stock performance might be affected by future events or executive decisions. And then, why is financial modeling important? Financial modeling is important because it helps company leaders make better, more data driven decisions. By creating financial models, companies can forecast potential outcomes, identify potential risks, and adjust their strategies. Scenario planning leans heavily on financial modeling as analysts run through assumptions and assess the possible risks and returns of decisions such as a major capital investment like adding a new factory, hospital, or retail store location. They use modeling to make financial decisions, such as whether to pay for those big investments using debt, equity, or cash. Financial modeling is essential to making sound financial decisions that deliver long-term growth. Knowing what value that growth can deliver and understanding what risk a company is taking to achieve that growth. And then, what is a financial model used for? Financial models are useful for many applications. Businesses commonly use them for the first, valuations and raising capital. If you're aiming to go public, for example, bankers will run financial models to determine how much the company is worth. You might also need to provide models in order to get venture capital funding, loans, or other types of financing. And then second, measuring possible outcomes of management decisions. You might use a financial model to predict changes in revenue and if you were to, say, raise the price of your top selling product next year. And then we move to the third, budgeting and forecasting. Budget and forecasting models help financial understand the company's performance based on input from its various components. As each program, department, and business units create its own budget, they can then roll them up into a single overall financial model for the entire business to be used to allocate resources and product financial results for the coming year. And then fourth, credit analysis. Investors will use financial models to determine the likelihood of your business repaying its debts if they are to lend you funds. And then how to use financial models. An analyst can use a financial model in several ways. The first, acquisitions. Financial modeling can be used for acquisitions to determine the range of possible outcomes that an acquirer can expect with an acquirer depending on the actions it takes after the deal has been closed. Each outcome results in different cash flows and a different valuation for the acquired business. And then the second, capital budgeting. Financial modeling can be used for capital budgeting to determine a range of outcomes that might impact the cash flow return related to a prospective fixed asset purchase. And then third, budgeting. Financial modeling can be used for budgeting to develop several scenarios as part of the budgeting process to decide which scenarios to pursue when a detailed budget is constructed. This is also a useful way to model the costs that will be incurred at different activity levels. And then fourth, risk analysis. Financial modeling can be used for risk analysis to determine which variables can have the greatest negative effect on a firm as part of a formal risk analysis. And then, who prepares financial models? The first, corporates. For internal management decisions based upon future business performance as predicted in financial models. And then the second, private equity funds, hedge funds, venture capital funds. For the calculation of their investment exit return. And then the third, investment banking firms on the behalf of both their clients and their investors for companies' valuation. And then fourth, management consultancy portfolio management firms for advising their clients on various growth prospects. And fifth, equity research firms for publishing the reports on public sources to recommend buying or selling of any security. And then types of financial models. The type of financial model used depends on its purpose. The first, three-statement model consists of the three major statements linked in Excel. The model is built so that a change in one statement is reflected in the other two. And then the second type, discounted cash flow or DCF model. Use cash flow from the three-statement model to value a company based on the net present value or NPV of a business's future cash flow. And then third, merger and acquisition typically uses a single tab in a spreadsheet for each company and a separate tab for the entity resulting from the merger or acquisition. And then fourth, initial public offering or IPO, used to value a business that's considering become publicly traded and make assumptions about investors' interests. And then fifth, leverage buyout or LBO model, builds debt schedules used to finance the acquisition into the model. So financial is very very important, especially financial modeling for the growth of all the company. I think it is enough. Thanks for watching.